Buying your first investment can be a scary and daunting thing. What if you pick the wrong suburb? How far back will it set you if you make the wrong decision? It can be very intimidating, right? So I've worked with countless people and I've designed this framework to help you succeed in your first investment property. And I'm here to share it with you, and hopefully it will help you in building and buying your first investment property and portfolio. So let's jump into this and go through what we are looking at. So how to buy your first investment property without costly mistakes. So this is a first time investor framework. Like I said, I use it with clients. I used it for my own property when I first started in this game, and I started building the portfolio, and I still do use 90% of everything on here today. So the first investment matters the most. Why? It sets the confidence, it sets your strategy, and it sets your future decisions. So getting this wrong can cost years, not weeks. And I think this is a very big issue that a lot of people face. They have that drive, right? They have the FOMO. They need to get into a property, but if they make the wrong decision, if I buy it if I put the wrong ownership, if I buy the wrong suburb, I'm wrecked for life, right? So what I do today can affect me 70 years down the line, and this is the biggest struggle, right? We have FOMO on one side, pulling you here, and then we also have the logical decision pulling you this way. And this is where it's very important to make sure that we have frameworks in place to stop this pull and make sure we make the right decision. So most first time investors buy with emotion, they buy with noise, they buy with opinions. You will see it in today's market. They have this FOMO, there's news everywhere. The housing market's shortage, there's this and that. And they're just injecting emotion into this. There's a lot of stuff saying if you don't buy a house now, you're screwed for the rest of your generations. And these are just opinions. These aren't factual stats. It's a lot of emotion, and this is what the first time investors deal with, right? So they sit on the couch, they have a TV, an old school TV here. I'm not sure if the younger people will know the TV. And then on top of that, they have the news, and they see it, and then they go into the office and they have friends talking about all of this stuff with emotions. Hey, you better get a house, it's looking really bad. And this is a terrible, terrible trap for first time investors. They have all of this input coming in, but really, what is the input and the output for the statistics? Where is the logic saying, hey, sure, you may have an increased house price now, but in 10 years, what's the growth rate going to be like? What's the populace going to be like? These are the stats that aren't coming in. So this is what this framework is for, to ensure that you're not purchasing based on these aspects here. And what usually goes wrong when you follow these emotional biases, you have poor growth, so you'll buy a house that is in a wrong suburb. Maybe it's a hype and saying, hey, suburb one has a 10% growth rate in 2025 alone. This is the best suburb. But then maybe we look at it in a 2020 to 2025, and maybe it's had like a negative 10%. So we have poor growth, hard to rent. A lot of people will buy, and maybe the suburb growth looks like it's going up, but maybe the rent is absolutely terrible. Maybe there's not enough people. Maybe it's got a bad reputation, right? So maybe there's a lot of Homes West houses in there, which are public housing. We also have negative cash flow stress. So people that buy with emotion usually haven't done this analytical part that we have up here. And then they end up having a negative cash flow. When they do that, usually the blame is, I planned that. I planned to have a negative cash flow because I want negative gearing. Usually people that say it will always blame it on negative gearing, which is a no-no in my books. You should always try to have positive, but that's a story for another time. And then they also have regret and hesitation, which is the biggest one. If you have regret and hesitation and you start seeing these poor factors that we discuss in here, what it will do is next time you have maybe 100K sitting in the bank, rather than go to housing, you will say, absolutely not. That was a bad experience. I'm not doing that. I'm going to put it into stocks maybe, and a stocks might be an 8% return, or a housing might be a 25% return. And they will be picking the 8% purely based on a bad decision, which was done before. So your first investment isn't about chasing returns. It's not about picking the hot suburbs. It's not following the whole market saying, yes, now is the time. It is exactly 375 days and it is the 12th minute of the 15th hour. It's time to get into the market. It's not about that. It's a very counterintuitive of how I look at the housing market, but it's about reducing risk. In 5-10 years time, will we still be performing and operating at the same capacity as we're doing now? What factors is going to change this? Are we going to go up? Are we going to go down? These are all risk. And I would say about 90% of first investors don't look at risk at all. They just chase the returns. They will look at maybe a 5-year growth chart and they'll say, yes, this has been growing on and on. The growth chart's like this. It's going great, but maybe what they didn't see is it was like this, right? So maybe this was 10 years prior and this is the last 5 years because we're in a housing boom. So every property should pass 5 checks, and it's a very simple check. The words may scare a few people who aren't aware of what there is, but we'll go through each individual one just after this. We have market fundamentals, demand strength. We've heard supply and demand, big in real estate. We have cash flow safety, and we have exit options. Usually, if one of them fails, the risk doesn't really outweigh the rewards. There are edge cases where it does. However, we want to make sure that probability of the risk is reduced. So we ideally need all 5 to pass. Now, what do 5 look like? Supply risk. Supply risk is oversupplying, right? So we have maybe one house and there is 10 people. Let's say that's 10 people, right? That's a low supply. So the demand for 10 people to get into here is high. So what's going to happen is they're going to start offering more price, and then maybe the third guy offers 3 bills like this. That's a low supply. If we have too many houses, it's the very overview. These are houses without roofs, and we have one person. Which ones are going to choose, right? Let's say this one's your house here. Let's make your house in orange. Which one's he going to choose? Maybe he might choose this one, and then all the rest are going to be a negative. So you can imagine how that supply can affect it. Another thing that can affect it is zoning changes, right? So if we have let's say these are houses for the start. Now, if zoning changes come in and now all of a sudden this one house can turn to a duplex or maybe a triplex, and this happens to all of these houses here, now let's just go with these 2 here. We've gone from a 3, 4, 5, 6, 7 houses here to 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 houses. So now this person has 11 houses to pick. Zoning changes can be good if you're on the right side of it. If you are looking at your certain circumstance where we're trying to rent it out, and rather than doing these long-term equity strategies, then zoning changes can make a big difference in terms of the strategy. Land availability is another one. So obviously, if there is a lot of land being released, there's going to be a lot of supply, which is going to be a lot of this. So we need a lot more people to pick. Investor saturation. How many people are going into there? How many people are trying to buy houses in this suburb? And usually an oversupply, I say that with a grain of salt, this is a very high overview, usually oversupply can kill performance. The second one is market fundamentals. population trends. Is the population going down in this suburb? We can go suburb, we can go town, city, or is it going up? Are there more people coming in? Which, as we saw here, if there's more people coming in, we start having a higher demand. Employment drivers. Now, a good way to think of this is, let's do a high rise here. This is the city. Let's just call this Perth. Perth City is the main city of Western Australia. We have high rises there. Before, houses were on a scale like so. And this distance, let's say 50 minutes. 50 minutes. This is a real case, and it's a very good way to look at this. People that could only get a job in the city, right, they would go the 50 minutes. Would they travel over nearly 2 hours for this person to get here? Probably not. So the employment drivers would be, you're probably not going to buy a house there. Now, this happened in a lot of north of the river. It's happening south of the river as well with Rockingham. It's happening with Mandurah. Did the exact same thing. You go up north. We're looking into Yanchep is a perfect example of that. What has happened is as houses get further away from the city, they realize to balance the scales, I guess, we need to add a work. So this is work here. So we need to start adding work, and we need to start adding infrastructure, which is this one here. Now what happens is this green no longer applies. And now to get to work is 10 minutes. And to get here is 10 minutes. And then all of a sudden, this house now becomes popular. These are employment drivers, and these are infrastructures. It's very important when looking at these within investments, because we ideally, although the house may not be good now or may not be, very, very short term, maybe these new houses, these new blocks have infrastructure and work drivers, employment drivers, that in the future, or maybe it's 6 months down the track, they're going to absolutely boom and skyrocket. And usually what happens is, the further away it gets from the city, the houses will always come first, then the employment drivers, then the infrastructure, minus the roads, because they go drive to the house. But growth comes from people and jobs. Now, if we look at the places like Rockingham, Mandurah, Yanchep, all of those are booming because now it's their own little community, right? So these people, should do an orange, these people now have their own little city, their own little bubble. These people have their own little bubble. Terrible circles. Bub 1, bub 2. And then the next one, there'll be a house that will start here, that's outside the bubble, travel distance, that won't work. Eventually they'll add employment, they'll add a work here, and then they'll add info here, and then it'll create another bubble. So that's a very brief overview of market fundamentals and a good way to look at new growth in new suburbs. Now, demand strength. We've gone through supply, we've sort of covered demand strength, but you have stuff like rental demand, vacancy rates, days on market, buy depth. A lot of this stuff can be found on many statistic sites. So we're on reba.com here, and you can sort of see days at time on markets is a very good indication. These are all free sites. We can see, I think we're in Subiaco at the moment, so one near the city in Perth, and you can see units and houses at 10 days on markets. We can also see growth rate in here. Along with this, we can also grab a lot more details. So housing data is available across many, many platforms, and you can see residential data and activities through many places like this. Now, I won't go too much in these, but it's very obvious. Obviously, one of the biggest demand strengths, if we're looking at rentals, would be public housing. And we also want to look at days on market, right? So days on market will be a supply. If we go back to this example here, let's see, we'll do a new example here. If there's a single house here and there's 10 people and they could only, let's just do 2 people, and they can only pick one house, then obviously they're going to pick there. It's going to get snatched up instantly. Now, if we add 3 houses, right, he might go there, he might there, that might be 1 day, and then 2 day, we might need to wait for a third person to come on the 3rd day, and then he'll grab that one. And that's essentially the demand aspect of it. Vacancy rate also helps. So if this person then suddenly decides to move out because maybe, there's crime, or maybe there's a work factor, infrastructure factor that we have over here, then they're going to move out, and that's going to increase the demand as well. Now, cash flow safety, we've gone through rent versus expenses. Obviously, as the house prices go up, you want a healthy cash net or cash flow. Another thing that we need to take into account, so maybe we're on $100 profit per week. When we're talking about reducing risk, a lot of this cash flow safety is in that risk aspect. So a rate rise, maybe if it goes up 0.25%, maybe your profit now goes to $50 a week. And we need to make sure that the buffer is in place in that. If we make $100 a week and then after 1 month, maybe the tenant moves out and the demand isn't quite there and there's an oversupply, then maybe there's a month to actually refill that. So how much can we sustain in that buffer period? So a lot of this is just the first deal should be boringly safe. So not exciting, but it should have a huge reduction in risk in terms of the cash flow safety. And a lot of this is looking at a 5-year and a 10-year plan, right? In 5 years, is my rent versus expense going to be the same? Is the rates going to go up or down, trending? Obviously, we can't predict it, but we can know pretty well due to complex stuff like the CPI and population growth and stuff. But we can take a pretty good prediction of what it's at in terms of inflation going up and down. And all of this can stem into the 5 to 10 year. And then to further increase these, so this one and this one, this 5 to 10 years, is exit options. Who would buy this later? In 10 years, can I sell this? 10 years equals sell, or does it have to be rent? A big factor on this, a good example you can look at is rural, right? Rural has a fantastic rent versus expense over here. You could make 200-ish and a lot more due to the mining in Western Australia in the rent. But the capital that goes up, the house price, in 10 years maybe equals 1%. So in terms of cash flow, sure, that's fine. But who would buy this later? Mining contracts, 5, 10 years, usually 10 years. When they all move out, how are you going to sell it? The house that is in the middle of Australia, will they be able to buy it? So it's a very important, based on your strategy that you want to do, whether you're doing more cash flow management, whether you're doing more capital investment, it's very important to take into factor who would buy it later. We also have owner-occupiers, investors, falls under this exact same category, and you have multiple exit paths. Are we going to create equity in the house? So am I going to buy a 500k house, renovate it, and have 600k, and then I'm going to withdraw 100k, and then we're just going to rent the house, right? So the Burr method: buy, rent, renovate, or buy, renovate, rent. Or are we just going to flat out sell it? So we made the 100k, and then maybe we're just going to sell it at this point. These are all other aspects that we need to look into. Now, most investors look at the price, yield, and opinions, especially the opinions. But what you need to look at is probability. Like I said, probability of the risk. We need to know, is this safe? You may be in a very good position now, but in 5, 10 years, are you going to be in the same position? Who knows? I'm going to take a sip of my incredibly cold coffee. So We don't try to predict the market, we manage the risk, increase probability, and avoid irreversible mistakes. Now, they are reversibles to a degree, but in this case where we buy a country town, it may take a while to actually recover if your main goal was not cash flow, but to leverage equity. So, for example, buying a house that may go like this, right? So house 1 might be here, house 2 might be here, house 3, and what we're doing is we're buying a house, pulling the equity out, buying the second one, pulling the equity out, buying the third one, and what this can do is lead to very fast growth. There's leveraging debt, a video for another time. Or maybe our goal is we want to steadily increase the equity here, but we want to make sure that our rent portfolio in terms of cash flow goes up. So we may not want equity, and maybe we want to get 300 a week, and then this brings 300, and this brings 300, and then at the end of 5 years, maybe our goal isn't to have equity, but it's to have $1,000 per week coming into the account. Now, irreversible, it's not irreversible in this sense, but you could see if we went this strategy and we got to here, and then all of a sudden we wanted to jump to this strategy, we could have lost a lot of time. Then we have serviceability and a whole other issues as well. So when we manage the risk and increase probability of what we're trying to do, portfolios survive long term and they follow the plan that they were intended to. So our role, or my role, is usually to do this, which is why I've made this framework. You remove the emotion, you apply a structure using the frameworks that I've given above, and you reject most properties. A lot of the times you'll find 100 properties is often a very good number, and out of those you'll reject 90, and then maybe there'll be 10 that actually meet everything. This is completely fine. A lot of people take around 100 houses of looking at and doing a lot of research to actually find the right one. My last investment, we looked at 60-ish houses. Some visited online, some we just ran numbers, but it took us about 60 to actually find this one, which has then made 100% profit, so 500K in 3 years. So don't be worried if you have a lot that you're knocking out, or don't just say, okay, oh my god, this is not working, it's taken 50 days, I've knocked out all these property and nothing's right. It's part of the process. So it is a lot less excitement, but you'll find the right one and your portfolio will thank you. Treat it like a business. Remember, we're taking no emotion out. So your first investment should give you the confidence and not stress. And the biggest factor I want you to take away is the goal is not perfection, but it's a solid foundation, especially first time home buyers, right? You're not going to hit the home run from the first one. You want to build your portfolio however you want it, and the first one sort of sets the scene to here, and then the next one. You want the foundation from the first one, get your experience without making the mistakes, and then the second one will be better investment, third one, and so on and so on. So if it's your first investment, you need to learn before you act. You need to look at the framework I've given you, take out all the emotion and act within the structure. Think of it long term. So think of 10 to 20 years, exit strategies, demand, population, all that sort of stuff. Go long term. It is always the best option. And then follow me for more calm, data-driven property investment. I'll be dropping videos daily or every 2 days, helping you and understand this market, because it's a wild time at the moment. And if you want to skip all that, or maybe you just don't have time and you need help with your first investment, I work with first-time investors who want to get it right the first time, and I do all of this for you and give it to you in a nice, pretty package. We do the negotiation, we do everything from the contracts, finding the property, doing all your attending of the home opens. All that is all handled by myself and my team. So until the next video, I hope this has helped you clarify a lot in the market and you feel confident in buying your first house. Until then, I will see you.